Welcome to your presentation for key statements, USAR and USALI for managerial accounting. Before we can start talking about the statements, we need to clarify one thing, and that is what an accounting period is. So accounting periods refer to the number of days when summary financial statements are prepared. So really it's the period of time, a specific number of days and dates, included in a summary of any kind of financial information. And so that is an accounting period. Accounting periods don't have to be the same for every single company. They are established by management, and so each management team will decide what an accounting period looks like for that company. There is some uniformity from hotel to hotel, from restaurant to restaurant, so that they can compare their businesses to other businesses within their industry. What you will see is many businesses will use calendar months, quarters, which are 3 months put together, so 4 quarters for the year, and then provide annual information, so an annual accounting period. You will also see months and quarters within a financial statement shown as the current, so what is going on presently for that month, and year to date. So if you were in February, you would see the February data, so the February information, the financial information for that accounting period, that month. But you would also see our year to date, which would be January and February added together, so that you know how you're doing so far. What you may also see is some companies using 28-day periods instead of months. So this makes sure that you're always comparing 4 exact weeks to 4 exact weeks, since some months have 28 days, some have 31, some have 30. Some years, February has 29. So by doing this, you can consistently compare 4 weeks to 4 weeks. Another thing you'll see companies do is comparing current information to historical statements, and so presented side by side. What you want to do at that point is compare that accounting period to a previous accounting period. A lot of the time you want to try and make sure that you are comparing similar accounting periods. Let's say we use a day of the week. A restaurant on a Friday night should not be comparing that information, those financial statements, to a Monday night, which may be not as busy. It should compare it to another Friday night. If we go to months, we should probably compare months in the winter to months in the winter from the previous year. Because if you compare, let's say February, a very cold month in Ottawa or in Canada, to July, nice and hot summer month, it would be very hard to compare the two, because you have different things that would provide business for that company, whether it be a hotel, a restaurant, or anything else. So please make sure that you feel very comfortable with what an accounting period is. The 4 key statements that are covered in this course, 3 are the balance sheet, the income statement, and the statement of cash flows. The statement of retained earnings is discussed. However, you should concentrate mostly on the balance sheet, the income statement, and the statement of cash flows. So what are they? The balance sheet provides a detailed running total showing what the company has, so what it owns, those are those assets, what the company owes, so the debts, any liabilities they have, and what portion of those assets are owned, and that's the owner's equity. The income statement, and my apologies, the balance sheet is a running total. It's a snapshot of a moment in time as to what the company owes, and of what they own, how much is owned. So what they own, assets, what the company owes, and then how much of it they own. Okay, so the owner's equity. So that's always a running total. It's an open account, a balance sheet, so it's always running. Okay, so you can always take a look at it and know after that accounting period what it's like at that moment in time. Now your income statement reports a specific time period, a specific accounting period. Okay, remember that. So a month, a quarter, a year. Okay. And what it does, it shows you all the revenues, so all the sales earned, minus all the expenses, the costs incurred to make sure those revenues happened. And then once you take away all the expenses from those revenues, it'll tell you if you have a bottom line profit or loss for that specific period. Income statements reset themselves from period to period. So they will not be running total unless you're looking at a year-to-date number. That will be several months or a couple of quarters added together. But it would mostly just reset itself unless it's year-to-date. Statement of cash flows is a very important statement because a company may actually be making money. However, they need to make sure that they also have positive cash flow or enough cash in the bank. Okay? So what a statement of cash flows does, it reports the inflows and outflows of cash or any cash equivalent. So liquid assets would be a cash equivalent because you can turn them into cash a bit quicker. It's important because a company always has to have enough cash on hand to cover your main operating expenses. So payroll, you have to be able to pay your staff, and to purchase assets. So as your assets start to depreciate, you would have to purchase new equipment. So again, the profit or loss from an income statement, it really doesn't explain a company's cash flow or a company's health enough. You would have to take a look at both. And then the statement of retained earnings is really to show accumulated amounts of profit over the life of the business. So far, how much has the company saved up as far as profits? Now, there are companies that are publicly traded that sell their stock, a share of their company, so that you can have a portion of their company, own a portion. If you do that and the company does well, you will sometimes get something called a dividend paid back to you. So you'll talk about more about dividends in your financial analysis course. But for now, let's start with the balance sheet. So what you see on your right hand side here is a USALI formatted balance sheet. We'll go through the example of this one in a second using Excel. So what is it? Well, first we have our assets, and it's what the company has listed in order of liquidity. Okay? So liquidity is how fast you can convert those assets into cash. Okay? So everything within current assets can be turned into cash within the next year. Now, they're listed in the way that they could be the quickest ones to convert it into cash, but also without losing its value as much. So cash is cash. You won't lose any value with cash, so it's already cash. It's the most liquefiable one. It's marketable securities, investments. You could pull them out and they could be turned into cash very quickly. Accounts receivable would be next. It's money that's owed to you. Will you always be able to collect 100% of your debts that people owe you within the next year? And can you do it quickly? And can you collect all of it? That's why it falls a bit below marketable securities. Same thing with inventories. If a hotel would have to sell all of its materials, you would have to try and sell all your inventory and then try and not lose its value. You would potentially have to sell it at a loss for the company. You wouldn't be able to sell it for the exact same price as you paid for your inventory. Okay. You do see net receivables here. That means that any bad receivables have been removed for this example. That means you're allowing for the fact that you will probably not be able to collect a certain amount of money that is owed to you. So that's what net would mean. Missing here, you might see prepaid expenses or something like that once in a while as well. Your property and equipment. Okay, so these would be your long-term assets that can't really be counted on for cash value. Notice depreciation here as well. So companies have to reduce the value of their assets as they get used up. So the asset depreciates by period, so on the income statement as an expense. But the total depreciation over time, the accumulated depreciation, is shown right here on the balance sheet. So it would be the value of all of these, not your land, but your buildings, furnishing, equipment, when you purchase them, minus how much you have depreciated, how much you have counted as an expense over time. Okay? Other assets right here could include goodwill, investments, and so on. For liabilities, you would have your current liabilities listed first. So current due within a year. So this would be money that you owe within the next year. So accounts payable, that would be money to creditors, any company that you purchased from that you just owe money to. Current maturities of long-term debt. So how much of your long-term debt is owed in the next year, and then income tax payable, something, just taxes that you have to pay. Your long-term debt would be anything that is owed after a year. Okay, so it's due outside of a year. And then lastly, your owner's equity. Your ownership type will dictate the way this actually shows up. It's the way it's presented. For a sole proprietor, it would just be owner's equity. In a public corporation, it's about the stock. So you would see your common stock like right here, and then you would have paid in capital, so money the owner adds to business or change of value in stock is right here. And then your retained earnings shows the accumulated profit less any dividends that were paid off, like it was mentioned, from the business over the years. And then if you were to add your owner's equity and liabilities together, you should equal what total assets are. So you should feel comfortable with the fact that your total assets, so that's your current and long-term assets, equals your total liabilities plus your owner's equity. Okay, so 10,409,510 should match right here. You can go to your example, your Excel example, and it will show you the exact same thing where you have it listed in order of liquidity for your current assets. Okay, and look at this example. So December 31st, 2000 X1, okay, that would be one accounting period, and take December 31st. So this would be at the end of potentially the year for this company. Okay, so at this moment in time, okay, you would see your balance sheet and what the value is of what you own, what you owe, and then out of what you own, how much you actually own of it. Okay, how much of it is not financed through debt. So feel comfortable with the balance sheet for sure. Now, you've heard me talk about USALI, USAR, okay? And what it is really is there's numerous ways to present income statements. Okay? A company could decide to do it in their own way, but it's in the best interest of a hotel or restaurant to follow a common layout, which is what hospitality organizations do. Okay? It's not mandatory, but really what you can do at that point is you can compare between locations, okay? Between your own locations, between your competitors, because a lot of hospitality companies use this layout. You can also compare it to industry standards. If you want to find out the industry standard or the industry average for the last year, there is data out there, and it's all outlined using a uniform system of accounts. Okay? So these statement accounts are called uniform system of accounts. You've got USAR, USALI, and then USFRC. So USAR is used for commercial food service operations. This information is published by the National Restaurant Association. Okay? Using these standards helps improve the ability of businesses to compare and benchmark each other when it comes to restaurants. USALI is on its 11th edition that came out in spring 2014, and it's effective until as of January 2015, so it was effective last year. It's originally created by the Hotel Association of New York City, and it's managed by the American Hotel and Lodging Association. And then lastly, you have your USFRC, Uniform System of Financial Reporting for Clubs. Okay? It's created by the Club Managers Association of America. We won't be using that as much, but any financial statements that we use, especially our income statements, we will be using USAR and USALI, Uniform System of Accounts. So now that we understand what USAR and USALI are, we can talk about that income statement. Okay? The P&L statement. So the P&L stands for profit and loss statement. So revenues means the amount of assets generated from doing business. So a hotel sells a room and gets cash for it. Restaurant sells food, which creates cash revenues for them, so it generates assets. For our industry, you need to make sure that you understand, first of all, understand that revenues minus expenses equals net income or loss. Okay? But what you also need to do is you need to really understand the outline for USAR, for the income statement for USAR. Now, we will only refer to our income statement USAR as income statement. Now, for USALI, we do use a bit of a different approach. And there are 3 different statements that we use, and they all work together. Okay? So hotels have many different departments, so each revenue center creates its own mini income statement, which are called departmental schedules. So think about food and beverage, rooms, other departments. Okay? And then, depending on who's looking at the information, you'll see summary operating statement. Okay? This is mostly for operators, so it won't include depreciation, amortization, interest, income tax expenses, because you're in charge of operating the business. You're less concerned about the depreciation and interest and income tax. You're more concentrating on making sure that you are operating your hotel in the most efficient way. Okay? Now, your statement of income, okay, is basically a snapshot for the owners that would include that income tax and everything like that, to really see the health, the quick health, and a quick snapshot of how the company is doing. You'll see the different outlines in a second. So let's start with USAR. USAR should have the following format. Revenues are split as food and beverage. It's often split in further ways, so liquor, wine, and beer could also be different ways. Sometimes it's split by service type, so takeout would be separated, or sometimes by area, bar versus dining room. There's a few different ways. That would all depend on that company itself, but revenues would always be listed first. It would then be minus the cost of sales. Cost of sales is the cost of receiving these revenues, the immediate cost. So that would be your food costs and your beverage costs. So those are directly related to these revenues. You needed the food, you had to buy food to then make food. Same thing with the beverage. So we'd go revenues minus your cost of sales. That would be the very next thing in line on the USAR income statement. And then we would go your payroll and benefits. So staffing is split in different ways. You might see management and then hourly staff, and then the benefits that's owed to them. It's sometimes split by areas as well, so kitchen versus dining room staff. Yeah. A very important thing is the fact that together these two are called prime costs. Okay? The reason why we refer to them as prime costs in this industry are the fact that these 3 represent the most controllable costs that management can control. So these are the costs that you can control as managers, and that can have a really big effect on this last little bit that we're going to see here, which is your income before tax. So you need to make sure that you're controlling your staff and what is going on to make sure you can make the most amount of income. Okay. Other controllable costs, so you would then take that away as well. So entertainment, glassware, marketing, utilities, and so on. So for a restaurant, you still control how much you spend on entertainment, on your glassware, on your marketing. You can still control those things. So you would list that right here. And that would give you your controllable income. So your revenues minus these 3 would give you your controllable income. So how much of that income you had control over. Now your non-controllable expenses, those would be more or less your fixed expenses. So occupancy costs, think about your rent, any lease on equipment, depreciation, anything like that, you don't have control over it. No control whatsoever. Your rent is your rent, whether you made $0 in revenue or $1 million in revenue. Okay? So you would take your non-controllable expenses away, and that would give you your operating income. Okay? Or sorry, your non-operating expenses minus your restaurant operating income would give you your income before tax. Now this can show up as either a profit or a loss. We'll go back and forth with our other statement, pardon me. So USAR income statement on your Excel sheet, you'll see an outline of one of these. So covers would be, you'd have your Chez Julie income statement. This would be for the year ending December 31st, 20x2. So this would be the year ending. Now, notice that it's right next to 20x1. That would be the previous year. So we would be comparing this year to that year. So first you would see covers. So how many people were served for the entire year? Okay, so that would be 233,600. So you would see that at the top using USAR. In this example, you see that revenue is split up by food, liquor, beer, and wine. Okay? So add them up, you would find out your total revenue. Your cost of sales, so remember that's your directly related costs to produce this revenue. So food is first, food revenue is there. Liquor expense, liquor revenue. So they're all in the same order. And then you would add them all up to find out your total cost of sales. And then remember, these are your payroll and benefits expenses. So management, service, production. So your service would be your service staff. Your production would be your kitchen staff. And then any kind of payroll, taxes, or employee benefits. You would add them all up because you would want to know what your payroll is at. Together, you would add these two numbers to find out what your prime costs are. Now, you may not understand why right now, but as we get into analyzing this statement, you'll see why it's very important to know that. So together, they'd be your prime costs. Then you have your direct expenses, your other controllable expenses. So your china, that would be your plates, your glasses, your silverware. Anything that you have control over, you would then put together in this section. Okay? Things that are not directly related to service to receive those revenues, but that do have an effect and you do have control over. And then you would add them up to find out your total controllable expenses. And then lastly, again, these would be mostly your non-controllable expenses that are fixed expenses. So when you take away from your revenue, we took away our cost of sales, our total payroll, and our total controllable expenses. That gave us our controllable income. And then if we take away from our controllable income, our total non-controllable expenses, that gave us our restaurant operating income. And if we take away from that or any kind of interest expense that's listed, we would then have our income before income taxes. So this would be a great example where a company, and we're fast forwarding in analysis a bit, but a company like this, a restaurant, would have had less in revenue, so you would think it did not have as good a year, so less people served. But if you take a look at the bottom line, this is current year compared to last year, they made more money. So that means that somewhere in here, they do a better job of controlling their costs. And that's what managerial accounting is all about, seeing how we did. Let's analyze these numbers and see where this company did better. Yeah. So that would be a USAR income statement, pardon me. Now, for USALI, remember that it's in different steps. So you have your departmental schedules first, which depends on that specific department because there are different profit centers. So think of a hotel, it has different areas, so many different areas. So they first develop their own mini income statement that outline the revenues for that specific department, the payroll and benefits for that department, and then other expenses for that department. So anything else that isn't directly related to these revenues. So payroll, and then you'll see food and beverage for USAR as well. Okay. So cost of sales is for USAR, you would still see food and beverage. If this was the food and beverage department, you would see revenues minus cost of sales. Okay. And then, yeah, you would just have your departmental income. So for that department, how they did. So it's very important to still break it down this way to know which department did well, which department delivered so much income. Are they controlling their costs? Are they providing more revenue than last year? You really want to break it down per profit center. Okay? And again, for an F&B department in a hotel, food and beverage costs will appear before payroll right here, just like they would in the USAR. Okay, they would show up in the same way here. So it's really just a mini income statement. So again, if we go to your Excel sheet, you'll see that you have your, for this one, it's a rooms department schedule. Okay? So your 2 different years. These would be broken down by the different segments for this hotel in particular. So transit room revenue, groups room revenue, contract. Okay? So this is the current accounting period versus last accounting period. Right away we know that, we should be able to know that it didn't do as well. Because if you take a look at 1.1 million compared to 2.2 million last year, we already know that the rooms department had a bit of a tougher time this year. So if we break it down, we would add all of our segments. We'll go in the current year, and that would equal our total rooms revenue. We would take away for this department our payroll and related expenses, okay, to find out what our total payroll and related expenses are. And then other expenses, so guest comfort, maybe your linen, it may be anything else related to just making sure your guests are comfortable, the laundry that you require for all your linen, any training required within that department as well. So total other expenses. You would then find out what your total expenses are by adding your payroll and your other expenses, and then go revenue minus expenses equals income or loss. That's the income statement calculation, and you should feel very comfortable with that. So this is, again, just for one department. You would have one of these for each of your profit centers. They would then show up on your summary operating statement, which is the next one we are looking at. So you've developed all your departmental schedules. Now you have to put together your summary operating statement. This is the one that you'll see used by managers mostly. So what you would want to go into one day, this is the statement you'll be using the most. So we start with operating revenues. All the departments are listed, so that's how it's broken down. Rooms, food and beverage, spa, telecommunications, anything like that. Next in line would be your departmental expenses, listed following the order presented in the revenues. So if the first line for your revenues is rooms revenue, the first line in your departmental expenses should be rooms expenses. Okay? So that's what you would do right there. Now we started with departmental expenses because they are directly related to these revenues. Now there are some things called undistributed expenses. So those are operational expenses that can't be allocated to a specific department. So if there was money spent on marketing for the entire hotel and marketed the entire hotel, it's very hard to specifically say how much of it should go to the food and beverage, how much expense should be attributed towards their department, how much should be towards the rooms department. Same thing with the administration. So you still need administrators to run the hotel as well on the back end. How do you decide how much of that expense should go towards every single department? So we really include it in our summary operating statement as an undistributed expense because you can't really allocate it to a specific department. So when we take these two away from our operating revenues, we are left with our GOP, our gross operating profit. Then we would take away our management fees, so any fees that you owe for management contracts or anything like that. That would give you your income before non-operating income and expenses. We would then take our non-operating expenses, so property taxes, depreciation, insurance, and so on. So these have nothing to do with your operations. You just have to pay these things. And that would leave you with the EBITDA. Be comfortable with this term, EBITDA. Earnings before interest, taxes, depreciation, and amortization. Okay? So please make sure that you're very comfortable with that. Then from the EBITDA, you would take out your replacement reserve, and then it would equal your EBITDA minus replacement reserve. So if we take a look at the same example, okay, and you click at the bottom, go to USALI Summary Operating Statement. I want to start off by connecting the dots. So, well, first let's take a look at the top. So we should have at the top here a line that says for the period ending December 31st, 2000 X2. Okay? That should be listed here so that we know which statement, what moment in time we're looking at, what accounting period we're looking at. Okay? So that should be right here. What you'll see in a summary operating statement at the top is rooms available first. So how many rooms available for the whole year? That would be the number of rooms available on one day times 365 days for the year. Your rooms sold would be next, followed by your occupancy. So if you have this information, you should be able to discover your occupancy. Your average daily rate would be your average daily rate for the whole year on average. Your rooms RevPAR would be for your rooms revenue, and then your total RevPAR would be your total revenue per available room. So RevPAR being revenue per available room. So you'd always want to list this at the top. That way we can already compare this current year to the previous year. So right away I can see that I sold a lot less rooms. My occupancy was less. We'll analyze more in weeks to come. Then as listed in the PowerPoint presentation, you'll have your operating revenues. So your rooms, food and beverage, other operating departments, miscellaneous income. So where do these numbers come from? Well, if we take a look back at our USALI department schedule and we take a look at 20X2 total rooms revenue. So we've broken it down by segment in our departmental schedule, but then we found out our total rooms revenue. This number is then brought over, so 1.757 million. There you go. So that's why we start with these. We find out per department how they did, and we've got your $1.757 million in rooms revenue. We would have another departmental schedule for food and beverage, another one for other operated departments, so on and so forth. Okay? And then if we look at departmental expenses, which would show up next on our USALI summary operating statement, you'll see $642,909. Well, if we go to our departmental schedule and take a look at total expenses, there's that number again. So all we did is from our mini income statement for that department, we brought it over to the summary operating statement. Okay? So very important to really understand that. Add them all together to find out the total departmental expenses and then to find out our total departmental profit. Now, USALI, we want to follow USALI as much as possible. Having said that, you will have some hotels that would add total departmental profit right away. Now, USALI doesn't require that you do this. It's just one extra step that will not really change if you wanted to compare yourself to other hotels or to previous years. The important thing is being pretty uniform for your own company and then being very close to the USALI so that you can compare as much as possible to the industry averages and to other hotels, your competitors, or other hotels within your chain. Your other undistributed operating expenses, so your administrative and general, sales team, how do you tell your restaurant how much is being distributed to them? You can't. It's very hard. Any operation and maintenance for the whole company or utility costs. So your total departmental profit minus your undistributed expenses would give your GOP, your gross operating profit. From that, we take our management fees to find out our income before non-operating expenses, so your property taxes, bank charges, everything like that. It's everything that I just explained in the PowerPoint. So that would give you your EBITDA less your replacement reserve. Replacement reserve being money that you're putting aside to replace things as you go. So you want to make sure you always have money on hand for that. And then lastly, we have our statement of income. So this is going to be really looked at by owners. It might be looked at by creditors as well to really have a good understanding of how the company is doing. And there's less, it's not that there's less structure, but it's really just revenues minus all the expenses lines listed with no subtotals, and then income loss. So you would list all your operating revenues, all departments listed. You would just list all of your expenses, all the lines listed with no subtotals whatsoever. And then you would keep your department's expenses listed one by one though. And then it would equal your income or loss before income taxes minus your income's taxes, and that would give you your net income. So again, if we refer back to our final one, you'll notice that all of these numbers will typically be right here. Now, a big difference being that depreciation and amortization, if we take a look right here, this is earnings before interest, taxes, depreciation, and amortization. Notice that depreciation is not showing up here, but it does show up on the statement of income. That's because as an operator, as someone who's operating the business, you don't really need to know about depreciation, how it's affecting your income statement. But on the statement of income, your owners and any creditors want to know about that. So notice that it's listed in order again. So our 1.757 that we got from this line, but we also got from here. Okay, so they're all connected and you're really repeating information. It just depends on who your audience is. Okay, and then all your expenses, starting with the ones that are attributed to these different profit centers. You include your depreciation and amortization, your interest, your income taxes. Okay, but you would start by your total revenue minus your total expenses, including depreciation and everything else that we didn't include the first time. And you would notice that on this statement, we were doing well. However, on this statement, we are not. Okay, so we were actually losing money at this point. So that's how you would show a loss of money. It would be in brackets, and that's why we wouldn't be paying any money at the end of the day. Okay. So, lastly, we have our statement of cash flows. It really reports the company's inflows and outflows of cash and cash equivalent, like I mentioned. It's important because a company must always have enough cash on hand to cover operating expenses like payroll. Okay? So the profit and loss, again, it doesn't mean that the company is doing well. So an operating activity would be any cash that is coming in or leaving the company that has to do with operations. Investing would be any type of investments that the company would be making. So whether they're spending money on investments or making money on investments. And then your financing activities would be how the company is being financed. So do you have money coming in from stocks, or do you have to pay out dividends? Anything along those lines. We'll touch base on the statement of cash flows as we go on. We'll have less. We'll touch on it less than the other statements because the income statement is really what we want to talk about. But if you add these three together, you'll get your net increase or decrease in cash for the period. Now, it could be a decrease depending on what the cash flows are, whether they're inflows or outflows from these three distinct areas. You would then add the cash at the beginning of the period to find out the net cash at the end of the period. So these three together will represent a moment in time. So it's a closed account. That would give your net increase or decrease in cash for that period. And then you would add it to the cash at the beginning of the period to find out at the end of the period how much cash you have left over. When we go through an example in the week that we cover the statement of cash flows, this will become clearer. Lastly, as a future business manager, you must be comfortable with these statements, especially the balance sheet and the income statement. You have to understand why they're there, understand how they're presented depending on restaurants or lodging industries, understand how to analyze them, how to explain past performance using them, and then you have to be able to use them to then forecast and plan for future performance. This comment right here, understand how to analyze them. Hotel executives and restaurant executives continue to come to us as professors and continue to make statements in the news about the fact that they have a strong need for analytical skills in their employees and managers. The stronger you are at analyzing financial statements, the more employable you become and the more valuable you are as an employee. So please take that into account with managerial accounting. So which statement helps best understand operational performance? The income statements. So in managerial accounting, we're going to spend the most time understanding that statement in particular and how to analyze it. We're going to dive deep into that as well.